Hey traders, and welcome to another episode of Haniva Trade Academy. If you trade using chart patterns and are unaware of these key points, you're likely not making a profit and are searching for ways to improve your strategy's win rate. In this video, you'll understand why these setups may not perform well and why your account balance is breaking even. By the end, you'll learn the main strategy for turning these setups into profitable opportunities. Join us as we provide a thorough and precise education on the secrets of succeeding with chart patterns. We don't just teach, we also illustrate concepts with practical examples, enabling you to apply them in trading. Before we begin, please support us by subscribing to our channel and hitting the like button. We are committed to teaching you everything you need to enhance your trading system. See you after the disclaimer and intro. Welcome back, traders. So, let's get started. As you know, chart patterns are divided into two categories: continuation and reversal. This classification suggests how patterns in each category should move. However, if you visit thepatternSite.com, you'll find that most of these patterns have a success rate of around 50% or slightly higher, and they are categorized solely based on a slight percentage difference between these two categories. So, we can disregard these slight variations and say that the success rate of patterns is 50%. On the other hand, the risk-reward ratio for most patterns is 1-to-1. Therefore, you need to increase the win rate or raise the risk-reward ratio to profit from trading patterns. In this video, we will discuss the following topics in order. What is a chart pattern? Applications of chart patterns? Types of chart patterns? Successful trading with chart patterns. What is a chart pattern? A chart pattern is a graphical representation of price movements drawn using trend lines and curves. Price patterns can be considered a natural phenomenon of price fluctuations in financial markets that emerge due to various factors, including collective human behavior. Chart patterns form the foundation of technical analysis. In technical analysis, price patterns are used to identify future market trends. Traders utilize price patterns along with other technical skills to make trading decisions, increase their likelihood of success in trades, and position themselves on the right side of the market. Chart patterns and candlestick patterns. Chart patterns have a direct relationship with candlestick patterns. If you see a chart pattern on a lower time frame, it corresponds to a candlestick pattern on a higher time frame, and vice versa. By switching time frames, we can better visualize patterns, find optimal entry points, and use these patterns in a multi-time frame approach to enter positions with minimal stop losses. For example, the engulfing candlestick pattern is a double top, and the shooting star candlestick pattern is a head and shoulders pattern. Applications of chart patterns. 1. Identifying probable future price movements. For example, if we have a head and shoulders pattern and its neckline gets broken, we expect a reversal movement to occur. 2. Having an entry point. For instance, after the neckline of a head and shoulders pattern is broken, the point of entry is typically at the pullback to the neckline. 3. Determining targets. The target is defined for all chart patterns. For the head and shoulders pattern, the target is typically equal to the distance from the head to the neckline. 4. Balancing movement, time, and price. It involves the expected price range and number of candles to form a pattern, and the time it takes to reach the target is approximately equal. 5. Having stop losses and a trading system. Trading based on patterns helps you adhere to the rules you have set for these setups, essentially allowing you to have a specific trading system and stop-loss placements that are a significant step towards profitability for yourself. Types of chart patterns. As mentioned earlier, chart patterns are divided into two main categories: continuation and reversal. In this video, we examine 7 famous chart patterns and showcase examples of each on the chart. Triangle pattern. The triangle pattern is one of the most common patterns formed by a combination of a horizontal line and a trend line. In this pattern, the horizontal line is formed by connecting the highs or lows of the candles. The triangle pattern, which is considered a continuation pattern, has three types: the symmetrical triangle pattern, the ascending triangle pattern, and the descending triangle pattern. The symmetrical triangle pattern is formed by connecting two converging trend lines and indicates that the price will soon break out of the triangle and move in a certain direction. Due to its symmetrical nature, this pattern cannot predict whether the movement will be upwards or downwards. The ascending triangle pattern is typically formed by a horizontal line at the top and an ascending trend line at the bottom, indicating that the price will move upwards after breaking out of the triangle. On the other hand, the descending triangle pattern is formed by a horizontal line at the bottom and a descending trend line at the top, indicating that the price will move downwards after breaking out of the triangle. Flag pattern. The flag pattern is another continuation pattern that usually forms after a strong upward or downward movement. This pattern also has two types: the bullish flag pattern and the bearish flag pattern. In the bearish flag pattern, we have a strong downward movement followed by a consolidation of candles resembling a flag in a short time. When this pattern occurs, we can expect the downward trend to continue. Similarly, the opposite scenario occurs in the bullish flag pattern, and the upward trend continues after breaking out of the flag. Wedge pattern. The wedge pattern is a reversal pattern formed by drawing two converging trend lines. An important point in this pattern is that the movement of both trend lines must be in the same direction. Otherwise, the pattern formed will not be a wedge pattern. This means that both trend lines must be either ascending or descending for the wedge pattern to form. If the pattern forms pointing downwards, it is referred to as a falling wedge. A falling wedge pattern indicates a likelihood of price rising, while a rising wedge pattern suggests a probability of price falling. Rectangular pattern. The rectangular pattern is considered one of the simplest and most popular price action patterns. This pattern typically forms after an upward or downward trend where the price is consolidating. During this consolidation, the price of an asset trades between two levels of resistance and support. Two horizontal lines are drawn by connecting the price peaks and lows, forming a shape resembling a rectangle. This is why this pattern is called the rectangular pattern. In a bullish rectangular pattern, the price moves between two support and resistance levels after an upward trend, and after breaking out of the formed rectangle, it continues its upward trend. The bearish rectangular pattern is the opposite of the bullish rectangular pattern, where the price continues downward after breaking the rectangle pattern. Cup and handle pattern. The cup and handle pattern is considered a bullish continuation pattern. This pattern typically appears during an upward movement that has paused for a while and indicates that the upward trend is likely to continue. The reason for naming this pattern is because initially, a pattern resembling the letter U in English forms on the chart, which represents the cup's body, and then another pattern appears on its right side, forming the handle of the cup. When the formation of the cup and handle pattern is confirmed on the chart, it can be expected that the asset will continue its upward movement with more strength. This pattern can also form during a downward movement, in which case it is referred to as the inverse or bearish cup and handle pattern. After the formation of this pattern, which is the opposite of the bullish cup and handle pattern, you can expect a price decline and the continuation of the downward trend. Double bottom pattern. The double bottom pattern is a pattern in which the price of an asset falls twice consecutively to the same level across different candlesticks, creating a shape resembling two valleys. In a downward movement, when the first valley forms, it means the price has reversed from its lowest point and moved upwards. However, it failed to sustain its upward movement, went down again, and formed the second valley. There are three types of double bottom patterns: normal double bottom, divergence double bottom, and number double bottom. Each type is illustrated in the image. The two valleys are aligned in a normal double bottom, and we enter the trade upon breaking the horizontal line. In a divergence double bottom, the second valley can deviate from the first valley, a value that will be clarified in future episodes discussing pivots. We enter the trade upon breaking the trigger line. In the numbered double bottom type, the second valley is formed higher than the first valley, and this value can also be higher by the extent of the first valley. In this type, we can also enter the trade upon breaking the trigger line. Please watch our previous video, which extensively discusses different trigger lines to better draw the best trigger lines for entering trades. Double top pattern. The double top pattern is similar to the double bottom pattern, but is the opposite. These two patterns can also appear in a triple form, known as triple bottom or triple top patterns. Head and shoulders pattern. The pattern of this model, as its name suggests, begins with a small upward movement, followed by a larger upward movement, and immediately after that, another small upward movement of the same shape and size as the first small upward movement. In this pattern, the small upward movements play the role of the left and right shoulders, and the larger middle upward movement represents the head. Hence it is called a head and shoulders pattern. When this pattern takes shape on the chart as we described, we can expect a price drop and a change in trend from bullish to bearish. The head and shoulders pattern can be considered a combination of a divergence double top and a number double top. Also, the head and shoulders pattern can appear in 9 different shapes on the chart, as illustrated in the image. In all cases, we can enter a trade upon breaking the neckline. The neckline can be horizontal, sloping in the direction of the previous trend, or sloping in the direction of the new trend. Furthermore, the right shoulder can be equal in height, higher or lower than the left shoulder. The head and shoulders pattern can also take an inverted form in a downward trend, in which case it is called the inverted or bullish head and shoulders pattern. This pattern is the opposite of the original head and shoulders pattern and is downward facing, signaling the end of a downtrend and the beginning of a price movement upwards. Successful trading with chart patterns. The video up to this point has covered all the important chart patterns, but that is not all we need. The most important thing we need to know is the success rate of each of these patterns. As mentioned earlier, these patterns are only categorized into one of 2 groups due to a few percentage differences, and in fact, they all have a win rate of 50% with a risk-to-reward ratio of 1:1. So, we need more than this to profit from these patterns. Please like our video before continuing, and if you are new, subscribe to our channel. We are committed to teaching you everything you need for trading. To succeed in trading with chart patterns, we need to consider 3 key points. If we focus on these aspects, we will succeed. 1. Identifying the time frames of levels. All levels on the chart have their specific time frames. By accurately identifying these time frames, we can avoid false breakouts and understand the value of levels relative to each other. This allows us to determine how likely is the price to break the level or reverse from the level. 2. Positioning of patterns relative to levels. For continuation patterns, the price should form the pattern after the breakout to expect a continuation of the trend. For reversal patterns, the pattern should have formed before the level to anticipate a reversal of the trend. For example, if we have a wedge pattern after the breakout, we should no longer expect a reversal movement, and the price is likely to continue as the wedge pattern is formed to fill orders. 3. Mission of breakouts. If the price forms the pattern after breaking the pattern level and reaches the next equivalent level before reaching the pattern target, we should no longer expect to get the pattern target. Therefore, based on the information provided, all these patterns can be either continuation or reversal patterns based on their position on the chart. The key to success in all patterns lies in the 3 key points mentioned. To learn about determining time frame levels, pay attention to pivots, and for accurate identification of level breaks, focus on the breakouts, which we will cover in the following episodes. Your trading world will fundamentally change, by learning pivots and breakouts in our style. Remember not to use any strategy or stop loss without testing and personalizing it. All right, folks, we've covered the desired topics about chart patterns. We hope you support us by liking the video, and if you're new here, subscribe to our channel so you don't miss out on our videos. Be sure to comment on what topics you'd like us to cover. We're striving to make you independent of all other educational resources.